frequency of economic crisis is more often, and three people here can take you through individual crises, and we can discuss the ramifications of each and how worried we should be by each. But the far seat is Dan Hansen, who's the senior UK economist. Dan previously worked for the Treasury. Alex Isakov has recently joined Bloomberg and previously worked at VTB in the Bank of Russia, and he's our Russia and Central Eastern European economist. And Anna Wong is our chief US economist, again, a recent recruit, and previously worked at, among other places, the Federal Reserve. I'm going to give Dan home field advantage. We're going to start with the UK, which has perhaps forced itself up the league table of crisis situations. Dan, Bloomberg Economics, you're forecasting the UK is going to slip into recession with winter approaching. We have a brand new Prime Minister who's obviously promising some relief on the way. The readers of Bloomberg's Alex Wickham yesterday learned the details of that plan, at least £130 billion of support for the next 18 months, £40 billion for businesses. She had said she wouldn't be giving any handouts. That's probably being rethought quite quickly. How would that kind of package, and obviously we don't know the details, we're just still going on our reporting, how much would that kind of package affect inflation and growth going forward?
Okay, yeah, thanks, Simon. So a little bit of context around our forecast. So we put our forecast together in the middle of August, and at that time energy prices were quite a lot lower. But we put it together and we came to the judgment that there'd be a peak-to-trough fall in output in the UK starting in the fourth quarter of this year all the way to the middle of next year, and the peak-to-trough fall in output of around 1%. Now that's very small relative to history. The financial crisis, output fell by about 6%. 90s recession, it's about 2% fall. And the big reason why the fall was smaller is that we assumed a big fiscal policy package would come through. And we assumed that there would be about £70 billion of energy support coming through. Now, as Simon's just said, the numbers we're talking about are at least double that. So it's going to have a massive impact on our forecast, and once we know the details, we'll be able to package it all together. But to give you an idea, and we put a note out on this yesterday, so if Truss does as has been billed, first of all, growth, we think, or the economy could well dodge recession. The size of the package is that big. The second key point is that we might be at peak inflation now. Instead of going up to 15%, you've seen these forecasts out there, 18%, you've seen 22% from other organisations. We think peak inflation could be around now if this package comes through, and that's purely on headline inflation. That's purely because the impact energy prices, direct impact energy prices have had on the CPI basket. The final point I'd make, though, the penultimate point I'd make is that underlying inflation is likely to be a lot stronger because you've bolstered household incomes, so you get this switch within the UK CPI basket from forecasting a lot of energy inflation to forecasting more domestically generated inflation. Now, you've heard from Hugh Pill this morning saying that actually that might be the bit that the Bank of England is potentially most worried about. So just finally, on the bank, Simon, I've rattled on quite a long way there, but on the bank, our forecast is for rates to peak at 3% early next year. I think in the near term, what this does is it takes away the urgency to front load if this package comes through, because the expectations channel that the bank has been worried about, that's diminished somewhat. So this argument between 75 and 50, I think it tips it back towards 50. But I think further out, there is definitely an argument for rates to go higher than we've got in our forecast, and potentially persistently higher as well. A little bit like Tom was talking about with the US, you end up going from an inflation problem that is energy plus labour market in the UK to a problem that's much more labour market and domestically focused. Yeah,
the new Prime Minister team there's real divide between her and her challenger Rishi Sunak on what more borrowing will do to fund for short-term cuts. Rishi Sunak obviously warning it would be complacent and irresponsible to ignore the risk. What's your view? Where do you come down on this?
So you've given the game away because I'm an ex-Treasury official, but so I think it's worth thinking about it in different parts. So the energy package, I think markets it is a huge amount of money, but the crisis is huge as well. So you're talking about pandemic-style support, but you're talking about pandemic-style intervention from the government. And all being well, that will be a one-off rise in the debt level in the UK, similar to what we had during the pandemic. I think what worries markets and worries economists is that there's no plan after that about how to pay that debt back down and how to balance the books and put things onto a sustainable path. The answer, it appears to be, is cut taxes and growth will come, and growth will pay for all of this. And I just don't buy that for 1 second. So I think what really worries people is a sustained widening of the budget deficit alongside this enormous current account deficit that the UK has. And I think that's why you've seen this dynamic in UK markets, at least recently, of rising gilt yields, falling sterling. It's that combination that people worry about with twin deficits.
Great. I'm going to move on. We are going to have some time at the end for questions, so I'll be thinking of your questions for Dan on the UK. I'm going to turn to Alex, and obviously, Russia, a huge crisis of its own making. The economy's contracted, or we think the economy's contracted less than perhaps predicted. Take us inside the Russian economy. What's going on in there, and where does it go from here, in your opinion?
Yeah, I think this was one of the largest surprises this year, like the pretty small contraction and small reaction of Russia to sanctions. I think if you want just a short takeaway, my feeling that it comes down to two things. First of all, Russia has overinvested into resilience compared to growth in the last couple of years. Since 2015, the Central Bank of Russia has closed more than half of its banking sector, leaving only like strong, large institutions and leaving very, very small scope for any kind of financial instability or uncertainty. So that is why the credit crunch never happened, because essentially they wind out all those small institutions and there was no uncertainty regarding who will survive or who will not survive. The second one is that essentially there was this false hope that Russia will contract 15%, and it was false because Russia actually never grew, expanded after the 2015 sanctions. If you look at the household consumptions in Russia today, they are at the level of 2010. So Russia has never actually recovered after the previous wave of sanctions. And so essentially, you cannot destroy something twice. This is why this round of sanctions tried to destroy something that actually doesn't exist. This excess consumption that was destroyed 5, 6, 7 years ago. So this is the story. On the outlook, my feeling is that, like borrowing a military jargon, it's much easier to play defense than offense. It's much easier to play into resilience than grow. Russia will face immense hurdles trying to recover from this even meager 4% contraction. Most of the foreign direct investments in Russia came from the West. Out of hundreds of billions of dollars of accumulated foreign direct investments, Chinese investment are no more than like 10, 15, 20 billion dollars. So they're very, very small. And as any emerging markets, it's just hard to impossible to grow without technology transfer and foreign direct investments. So even despite Russia contracts like 4%, 5% on a cumulative basis, it will take 7 to 10 years to recover from that, because structural growth will unlikely exceed 1% per year. Otherwise, Russia faces two challenges. It produces a lot of energy and a lot of natural resources that it cannot consume, right? This is the model of the country. And currently, it ponders what to do with all that excess foreign revenue. Because from the Russian perspective, the revenue that it used to get for natural gas was largely imaginary. Two questions that you need to ask is whether this money can be seized or spent. And Russia was like open to both with regards to this euro revenue. So I'm pretty pessimistic that the exports will recover anytime soon.
What role does the G7 price cap have, and perhaps more broadly, what role energy prices will play in determining how sharp the decline is for Russia?
The question is whether Russia needs this revenue. Essentially, if you look at the Russia's imports, my feeling is that they've yet to recover to pre-war levels. But what's recovering is consumption like goods. They are finding a way, the sanctions are porous, but if you can't import equipment, then you really don't have a need for that revenue. So I think that the threat that if the cap is imposed, then there'll just be no exports is pretty credible.
One of the things you've written about, which I think is interesting and is perhaps an unintended consequence or a fallout of this, is kind of Turkey and Russia's relations. And Turkey, they've agreed to partially switch payments for natural gas shipments to rubles. What does that mean for Turkey?
What I think you need to understand about this is that national currency payment is just a jargon which ultimately means ruble lending from Russia. So national currency payments, like the fact that Turkey may be paying for half of its imports of natural gas from Russia in rubles, essentially means that they will be financed by a Russian ruble-denominated loan from some Russian bank, presumably implicitly guaranteed by the Russian state in rubles. So that should take a lot of heat from the balance of payments. And Turkey imports a lot of energy. It imports, I think, like $50 billion per year just on the natural gas and oil and petroleum products. So that is from the Turkish perspective, very beneficial. From the Russian perspective, actually, this debt is the closest that you can have to a safe asset.
Anna, turning to the US, still the big dog in this fight and this situation, and we're looking at a US that typically has helped the world at different times, and now we're not quite sure where it's going. How do you assess all the multiple risks that are building in the world's largest economy, be they inflation or recession? How do you bring them all together in your outlook?
Yeah, I think for the U.S. economy, the biggest risk is that inflation could be higher next year, and the Fed may have to do more. If the Fed will have to do more, then the world economy would be more affected by the spillovers, right? And there are two sources of risk from my perspective where inflation could be higher next year. So, you know, the market consensus right now is that inflation would fall below 3% next year. We think that it's more likely that core inflation would be hanging around 4%. In fact, our global modeling team has this risk-based model, which sees almost close to 0% chance of it falling below 4% next year, which happens to align with our judgment as well. And I think that the two potential sources of where inflation could hang around longer is, one, if supply bottlenecks persist. But even if supply shocks don't materialize, and in fact, supply bottlenecks have been easing in recent months, even if that happens, another way that inflation could be substantially higher is if labor productivity growth slows in the U.S. and nominal wage keep rising. And just to give you guys a little bit of stats about the U.S. economy, so various wage metrics is pointing to wage growth running between 5 to 7% currently. And productivity growth in the first half of this year was actually negative 4%. This means that the unit labor cost in the first half of this year in the U.S. is actually 10%. And whenever unit labor costs exceeds how much businesses can mark up their prices, there would be upward pressure to core inflation. So, you know, and I'm sure everybody paid attention to Jackson Hole, but one of the interesting agreement or consensus that seems to emerge from among the central banking community in Jackson Hole is that productivity growth likely would return to pre-pandemic trend. And that, for my eyes and ears, that seemed a little bit optimistic. I think we have learned from the lessons in 1970s and 80s that inflation is actually bad for productivity. Inflation changes relative prices, and for firms that have already invested in capital, that just put all sorts of stuff out of obsolete, and efficiency gains of production decreased. Second source of productivity slow down is also the uncertainty of inflation. When firms invest in capital, they want to be able to forecast the stream of profits from that capital, but if they don't know what energy prices will be next year, or whether the supply bottlenecks would linger around next year, it's hard to put all that money into place. So with less capital invested, there will be less capital per worker, and labor productivity would suffer as well. So anyway, I just see risk that wage growth adjusted for productivity would persist at 5% or above next year, and that would push inflation, core inflation in the U.S. around 4% or higher.
And in your view, those are the reasons you see rates going to 5%, which are about a percentage point more than the market. And Anna's too modest to say. Anna was one of the first economists earlier this year, I think, when it was to predict multiple hikes from the Fed, which some of us thought was back as early as January. There was only going to be a few hikes, and obviously with Anna's been proved right and was ahead of the market. So explain that gap. What is the market missing that takes you to that percentage point? Is that the productivity? Is that the core?
Right. So we think about where Fed would raise rates to in a couple of ways. One way is to think about where optimal monetary policy rules would say. So, Taylor rule would say that a Fed funds rate would be a function of unemployment, forecasted unemployment, a deviation from natural rate of unemployment, and also forecasted inflation deviation from the 2% target. And we're thinking that the natural rate of unemployment is more at above 5% or even 6%. And even research from the Federal Reserve itself is pointing to about that magnitude. And also Powell had himself said that the Fed is looking at headline inflation. So the 4 quarters PCE inflation is pointing to an inflation rate running at about 6-ish%. And so once you put all these ingredients in that policy rule, it will point to about 5-ish for terminal rate. But also, I just think that another way to think about this is think about how restrictive Fed funds rate will have to be. So one of the long-standing dove on the FOMC is Charles Evans, and he explained his reasoning. He said that he envisioned real Fed funds rate to be running at 1.5% next year, and you add your expected 1 year ahead inflation to that 1.5%, that gives you the nominal Fed funds rate. And so he thinks that inflation a year from now would be, just 2.5. That's why he wrote down 4% terminal rate. So we think it's more running at 3.5% for the productivity slowdown reason, wage growth reasons. So that's another way to think about, why we think that 5% would be ultimately the rate that the Fed needs to rein in inflation.
We've got the midterm elections coming up. You're not a political analyst, but given what you know about the economics, given the kind of historical examples, what lies in store for the House and the Senate based on economics, while acknowledging social issues obviously play a role as well?
Yeah, so speaking purely from the economics perspective, my team has constructed a misery index for each of the U.S. states. So a misery index is just the sum of inflation and unemployment rate, and it could predict pretty well how the House race would turn out in the past. And currently, it's pointing to the House losing about 30 to 40 seats. So I think it's quite likely that the House will be, the Republicans would win back the House. But the Senate race is more of a undetermined right now, given all the social issues you mentioned. But I think that if it turns out that we do have a separate house, split house, Congress, that usually would mean no fiscal stimulus forthcoming, and the Democrat Party would be in a lame duck situation until 2024. And I suppose from inflation perspective, that would be good.
Great. We've got a few minutes left, and obviously I invite questions from the floor to all or one of our panelists. If you can raise your hands if you've got a question, perhaps identify yourself when I think someone's bringing a microphone to you. The gentleman here in the middle.
Thanks. It's Daniel Marnie, economist at Handelsbanken. Two questions on the UK, and it's both to do with the trust plan and energy prices. And this is addressed to you, of course. I think your implication was that you thought that the plan would embed higher core inflation going forward. One challenge to that, which is, given the plan will lower headline rate of inflation and make sure it's persistent for much less time, don't you think that could mean there's less likely to be second-round effects and less pressure on wages, for example? I thought that could potentially, in the long term, lower core inflation. So just wanted to get your response on that. And then in terms of the debt implications, obviously about a quarter of UK gilts are linked to RPI. One of the positive things to come from this will be that there'll be much less debt interest payments, which will obviously carry over on an annual basis. Isn't that quite a clever way of making sure that the financial implications of this policy are not quite severe for the public finances? So just a couple of points, really interested to hear your views.
Yeah, so on the debt interest point, we put something into the note we put out yesterday about that, and it would save about 30 billion. So it's significant. I mean, in the context of 130, it's a quarter of it. So it's a lot. And on core inflation, you're absolutely right. There are two elements to it, aren't there? There's the inflation expectations channel, and there's lower unemployment for longer. The unemployment rate not rising, the labour market staying tighter for longer. And I guess it's the balance of those two things and which of those two things you would think would dominate over the medium term. Now, at least through the lens, I think the way the bank would think about it is that in the near term, as I said in the answer earlier, that the expectations channel has probably become a little bit less worrisome. That said, you look at their decision maker panel data, which is the survey data that they ask businesses about their year ahead wage setting expectations and price expectations, and something that Hugh Pill's really spoken a lot about, and I think probably a lot of that drove the 50 in August. That's still elevated and it's still high. So I think there's a point there that yes, peak inflation will be potentially, well, it won't be as high. That if this plan comes through. The fact is inflation is still very high though. In absolute terms, it's still at 10%. I think in the medium term, what the bank will really worry about though, and what they rely on in their forecasts to bring inflation back down, is unemployment going up. I know it's a sort of very negative thing to talk about, but I think if they see unemployment staying flat because of this extra boost to income, this demand boost, I think they'll see core inflation and headline inflation, once the energy impacts drop out, they'll see it as more persistent. So I think that would probably dominate their thinking, and I think it would dominate our thinking as well. I mean, as I say, we're making these judgments on something we read about yesterday. We need to put our forecasts together, but I think it's that force that will dominate in the medium term.
Who else has a question on the floor? I can't see two hands over there.
Hi there, Alex Tuckett from CRU. My first question was for Dan, again on the trust plan. Rightly, there's been a lot of focus on households and the higher energy bills they're facing, but obviously businesses in the UK have been facing the full wholesale price with no price cap. And if they don't have hedging, they're facing the spot price. Obviously, you don't know what's in the plan yet, but how important is that channel been so far in raising core inflation, non-energy inflation? So, for instance, if I'm a restaurant and my energy bills are going through the roof, and you know how important that is. And my other question, I'll be cheeky and ask a quick one of Alex, is what's the future for the Russian car industry? Is it will it be owned and run by the Chinese car industry? What does that look like?
So to answer your question, Alex, the point, I think the key point I'd make, and a lot has been said about this, is in the services side of the basket in the UK. So services inflation, I think, and I'm going to be, it's around 5.5%, and I should know that number, but it's around 5.5%. If you look at the long run average, it's about 3.5%, a little bit below that. Now, the bankers focused on that, and we focused on it a lot, and you can apportion some of that to the tight labour market, but you certainly can't apportion all of it to the tight labour market. And I think the other bit of it, and we haven't got estimates for how much you can split between the two things, so I'm not going to try and do that for you. But I think it's very clear that from April time, services inflation took off like a rocket in the UK, and much of that is to do with energy prices. So it was really important yesterday, and well, not that the announcement's been made, but with all these leaks that have come out, it's really important that some of it is going to business as well, because it's not a household problem at all. It's very much a business problem as well. And just to add to that, I think one of the key things that people have been looking for over the past year or so with inflation is core goods inflation coming off, like the supply chain disruption easing, core goods inflation comes down, and that's at least one area where inflation starts to ease. Actually, that, I think it's, Anna will correct me, but I think it's come off in the US. In the UK, it's come off a little bit, but it's started to settle a bit again at a high level. So that decline has slowed. And I think, again, you can apportion some of that at least to energy prices. So you're absolutely right, but I'm afraid we haven't got any sort of estimates for it for you.
Alex, the future of the Russian car industry.
So my impression is as follows. I don't think that it will be dominated by Chinese manufacturers for two reasons. Kind of the push and the pull factor. First of all, I don't see much efforts to bring them on board. For example, Russia has reinstated a program of discount interest rate loans for car purchases, and it just doesn't include the Chinese producers. They had the opportunity to tweak this program, but have not included the do you know the brand, the Havel? It was, at the time, it was just the only car produced in Russia for a period. Nobody produced cars, just this one plant in Tula for a month and a half, and they are not included in this program. So I think this says a little bit about that. But also, I don't think that on the Chinese side, there's a great push into the Russian market. So if you look at major companies such as Huawei, they are relocating their people into Kazakhstan, right? So they are not rushing into this market at in great numbers. So probably not, but not for good reasons.
We have 2 minutes left. There's a gentleman there with his hand.